There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.
Hi everyone, today I want to talk about high-frequency trading firms, what they are, how they function, what they do, why they're still in the market, and what you need to know to avoid them, because they can be devastating to your profitability and return on investments if you trade against them. High-frequency trading firms are the morphing or the evolution of the day traders of the 90s that were professionals. And the late 80s, when home computers, even before the PCs and Microsoft and all of that became powerful, there were home computers, and for the first time floor traders could literally work from their home or trade from a computer and trade the markets. And a lot of them decided to leave floor trading and become what was called the SOS bandits, or rogue traders, who were professional traders who knew how to, what was coined day trade. What they were doing was they were doing the exact same thing that they did for their market maker employers, only they were doing it on their own. They were trying to make money between the bid and the ask. And in those days, the market was based on fractions. An eighth, a quarter, a 16th, that sort of thing. So everything was based on quarters, 25 cents, 50 cents, 75 cents spreads. And the spreads were huge compared to what they are today. So back in the 80s and 90s, when fractions were still around, it was very profitable to be a professional day trader. In the 1990s, with the internet and the World Wide Web, slowly brokers started going online, late 80s, early 90s, and retail brokers started offering services online. There were all kinds of them. They were mainly for long-term investing, but as the market started going really strong and became a really great bull market with new technologies and everything, more and more investors wanted to come into the market, and day trading was introduced to the retail crowd, and it became an instant overnight success. Everybody wanted to day trade because they thought it would be really easy. It sounded easy. All you have to do is buy here and sell here, and you can snatch $1 or $2 off the table in a few minutes. It sounded fantastic. Oh, you can make a fortune overnight. Day trading for retailers, there were all kinds of day trading rooms that cropped up everywhere where people went in and used computers because they weren't that popular yet. Not everybody had computers. And they could go in and they'd watch the news and they'd try to trade and day trade just like the professionals with no experience, no market knowledge, not the years and years and years of working with a market maker like the professionals, the SOS bandits had. They were just new traders who didn't know very much, who took 1 week of how to day trade and then thought that they would become millionaires. Most of them lost a huge amount of money. And then options became popular, and so everybody rushed to trade options because, oh, that was easier than trading stocks and it was lower risk, blah, blah, blah. As time went by, the market makers got weary of having to trade against all of this activity. The day traders, the options, the SOS bandits, the professional traders were all out there trying to cause problems in the market. And the institutions for whom the market makers often set the price and bought and sold stocks and helped them invest in hundreds of thousands of shares of stock, buying incrementally, also were getting very upset. The buy-side institutions were very frustrated because whenever their 100,000 share lot order showed up on the market maker's limit order book, all of a sudden all the day traders and all the retail traders, everybody was rushing to try to buy that stock, drive it up before the large lot could be executed. So what the professionals did, the buy-side institutions and the market makers, is they went to Congress and they said, hey, Fractions have been around a long time, and we understood the fractions. And before the 1990s, there was mostly professionals, and you would just go through a broker, and the broker would set the price, and you would just buy it at whatever price he said. But with the internet, it changed everything. So they went to Congress and they said, well, the poor retail traders and retail investors, they really can't understand fractions. They really can't understand what's going on. We need to move to decimals. And so it was approved. The SEC approved it and everybody approved it, and they went to decimals in about 2002. Well, that changed the landscape. The professional day traders who'd been making lots of money because they knew what they were doing and they were experts at moving in between the bid and the ask, found that now all of a sudden, instead of wide spreads of 25 cents or 50 cents or 75 cents, where they could really snatch some good profits with 10,000 lots or 50,000 share lots, they were trading very large lots. They discovered that those margins narrowed and narrowed and narrowed until there was only a penny between the bid and the ask. And the buy-side institutions said, well, this is an efficient market because the bid and the ask are so close. The intent was to squeeze out the floor traders and the professional traders and the rogue traders and the day traders from the retail side, get rid of them. But it didn't. It put a lot of retail traders completely out because they lost everything, and the retail brokers took a huge loss on margins because retail traders lost so much money during that era between 1995 and 2005 that retail brokers had to really reassess. A lot of them went under, a lot of them merged. It was a big time of trouble for retail brokers. But what happened is that the rogue traders, the professional traders, and the floor traders who had been making millions and millions and had been very successful saw their spreads narrow. So they decided that they needed to use faster computers. If they could get a faster computer, they could get to the market sooner, and they could continue to use the penny spreads with much larger lots, or many, many small lots all at once. And that is how high-frequency trading became what it is today. It is the morphing or the evolution of the rogue professional traders who broke off in the 80s, the early 80s, when they discovered they had a home computer. And as time evolved and PC computers evolved, and then eventually they were able to go into very high-speed computing capabilities. They were providing tremendous amounts of liquidity to the market and the exchanges at a time when the exchanges were losing liquidity, were losing all kinds of activity because the buy-side institutions had gone to the SEC and said, hey, we need alternative venues. We cannot possibly trade on this market anymore. We're being manhandled by high-frequency traders and everything else. So the SEC approved dark pools. Dark pools are off the exchange alternative trading venues where giant lots are transacted, where no one can see that transaction unless you take a TechniTrader course and you learn how to read the footprints and use specific hybrid indicators. That's what I teach my students, is how to recognize the footprints of dark pools, professional traders, and HFTs. Now back to HFTs. HFTs kept getting faster and faster and faster computers, more powerful computers. They hooked right into the exchanges, so their orders were instantly in the market as soon as possible because it's price time quantity is the order in which the orders are taken usually. And they could tick up a half a penny or a penny and get ahead of other trades because they would push the price up. And they became very, very powerful. They were considered maker-takers, which means that they can make a market or take the market. In other words, they are paid a commission to offer out liquidity for the exchanges. And that's why they still exist today, because they provide liquidity to the exchanges when so much of the volume is now off of the exchanges. And the exchanges in the U.S. have been struggling financially. They're trying to find alternative ways to get more and more volume, more liquidity back onto the exchanges because everybody went to off-exchange trading systems and trading platforms, the bulk of the market. You have to understand that the mutual funds and pension funds buy vast quantities of stock for long-term investing on behalf of their fund holders, whether it's a mutual fund investor or a pension fund investor. They have millions and millions of shares of stock in inventory that they hold for the long term. And yes, they can short-term trade as much as they want. The rule of three changed that. That's something that you would learn in the TechniTrader courses. The HFTs are here to stay. The SEC has decided that they provide sufficient liquidity and they offer all kinds of benefits to the exchanges. Some of them have become market makers, and the SEC is still trying to decide whether the maker-takers who earn a commission by providing liquidity or should be, if those who are maker-takers should be actually market makers. Now, there are very few real human market makers anymore. Everything has become computerized. So if you hear somebody say, oh, blame it on the market makers are why you're losing money, they have no idea what they're talking about because that era is long gone. HFTs are generally front-running, and you have to consider them predatory. They follow all kinds of things to see where anomalies in order flow is. If there's clusters of orders of everybody wanting to buy this stock, they're going to front-run it. And how they front-run it is they can inch price up a little bit, and the speed at which their orders can enter the exchange ahead of what your order that your retail broker fills and then sends forward to be acknowledged after the transaction has occurred, because everything's recorded, everything's documented. But the HFTs can front run, and they do. They can gap up or gap down hugely. And what's happening recently is the twits and tweets that everyone is following have become the favorite feeding ground for the HFTs. They track what's being promoted or being talked about, and then they will gap that stock in the direction that the conversation is going. So if everybody is all bullish and everybody's wanting to buy stocks and they're talking on tweets and twits and social media and other areas, the HFTs can pick up all that information. They assess where the bulk of the interest is. They send a flood of orders into the exchange ahead of the retail crowd, and they gap or run the stock up within the first few minutes of the trading day. And then the retail orders come in behind it, and they push price up further while the HFTs are selling for profit. That's how it works. So a lot of times, the HFTs may be going actually against the fundamentals. Maybe everybody that's on tweets and twits and social media thinks that this stock is great and wonderful, or they hear something and they all are deciding they're going to run and buy it. Well, even before they place their orders, the HFTs are gapping it. They're gapping it to the upside. And this is becoming a problem because some of those gaps are huge, but the fundamentals are not that great. And if this is a long-term investment rather than a short-term trade, that retail investor is going to be sadly discovering that as the reality of the fundamentals settle in and that stock starts to decline because dark pools decide, okay, this is a good place for us to start selling more of those shares of stock because we know this company is in a contraction. We know this company is in its business cycle that is going down, and all businesses cycle. They have an upgrowth and a downside. They cycle on a regular pattern depending on that business itself and the industry they are in. Meanwhile, HFTs are getting everybody to buy high, so then the dark pools are going to sell into that buying because they want to lower their shares to mitigate the risk of the downside of the business cycle. They may not sell all of the stock. They rarely do unless the company is in really terrible shape. Most of the time they have to hold some, but they can adjust their portfolios and move around money to maintain their 4 to 8% that the mutual fund investors and pension funds are expecting. So that's how they manage their funds. They just move money around from different stocks based on business cycles for that company. And then they are able to maintain a small growth in that mutual fund or pension fund. It is usually far lower than the percentages that we see on the indexes or individual stocks because they're not trying to get the highest return. They're just trying to get a reasonable return over time that they have based it on. HFTs are here to stay. They are predators. You need to keep an eye out for them. You need to be aware that if you're using stock tweets and stock twits, you may be buying a stock at a new high that will collapse because the fundamentals are not there to sustain it. That is something you have to consider. You have to also be aware that a lot of times you're paying more than you should for that stock if you're using that because the HFTs front run it on a regular basis now. That's their latest, greatest algo that they're very happy with, and they're making a lot of money. Just because your friend or your coworker has bought a stock or everybody is buying it doesn't mean you should be buying it. You need to investigate. You need to learn how to use technical analysis to see what's going on with the stock. You need to understand the new fundamentals that are also in stock charts. You need to understand all the different variables that are going on. Otherwise, you will be very disappointed at some point, especially if you're a long-term investor, and you will find that you have bought stocks at very high prices and now they're collapsing, or they will collapse at some point because the fundamentals are not there to support it, and then you'll be angry because you think the stock market cheated you. And that's the problem. If you're buying something just because everybody else says it's a good buy, then you're a speculator. And speculators lose a lot of money in the market because they are gambling. The stock market is the business of business. There is no place for gambling in the stock market, although lots of people do. And they lose a lot of money because they're gambling. They're not investing. So you have to ask yourself, are you gambling or are you investing or trading? Because if you're just following all of the social media chatter and just buying what everybody else is, you're not investing. You're speculating. And at some point, you're going to lose a lot of money. I'm Martha Stokes, and that's our radio show for this week.
There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders. And certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.